But I can tell you, if you own gold, you are going to have an official, call it a tailwind, because governments all over the world are wanting to revalue gold higher in order to create more liquidity and ease the debt situation. But understand, for years and years, forever up until now, the U.S. Treasury / Federal Reserve never wanted the price of gold to go higher because it's a direct competitor with the U.S. dollar.
The resurgence of interest in gold revaluation reflects deeper concerns about the resilience of global financial systems. Far from signaling economic strength, such discussions point to a growing loss of confidence in public finance, the stability of fiat currencies, and the prudent management of mounting sovereign debt. As this trust deteriorates, gold reclaims its vital role as both a hedge against inflation and a geopolitical safeguard. This trend is further reinforced by the declining dominance of the U.S. dollar in global reserves, particularly amid central banks' significant acquisition of 900 tons of gold in 2025. For decades, U.S. policy has aimed to suppress gold prices to preserve the dollar's supremacy as the world's primary reserve currency. Yet, mounting debt levels and renewed debates about revaluing gold to enhance liquidity suggest a potential shift in strategy among global governments. Bill Holter, a respected expert in precious metals, draws parallels with the hyperinflationary collapse experienced by Weimar Germany, warning that revaluing gold may become a necessary, albeit desperate measure, to stabilize economies without further increasing debt burdens. With the United States holding approximately 262 million ounces of gold, Holter estimates that gold would need to reach nearly $125,000 per ounce to offset the national debt of $36 trillion fully. Supporting this perspective, a Federal Reserve report released in August highlights how several countries have leveraged gains from gold revaluation to strengthen their fiscal positions and mitigate central bank losses, all without physically liquidating their gold reserves. This evolving dynamic coincides with a broader global realignment, as many nations progressively reduce their reliance on the U.S. dollar and Treasury securities, signaling a fundamental reset of the international monetary framework. Holter's central thesis is clear. The global financial system rests on an unstable foundation when the world's reserve currency is issued by a government facing significant fiscal challenges. Unlike prior theoretical concerns, this shift is now visibly underway. The persistent inflationary environment and deteriorating fiscal outlook have undermined confidence in U.S. economic leadership. Notably, policy reversals earlier this year triggered rare concurrent declines in both the dollar and Treasury markets, with the dollar index falling more than 10%, its steepest first-half decline since 1973. Now, we present the clips from Bill Holter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Obviously, there was a financial reset in 1944, Bretton Woods, another reset in 1971 when we went off the gold standard. I guess, and this is the way, when I talk to people regarding the current situation, my first question is the U.S. government bankrupt? Are they broke? And 95% of the people will say, well, of course they are, but it doesn't matter. And then my next question would be, who is the issuer of the world's reserve currency? It's the same entity. Mm-hmm. So you have a financial world that's running on top of a foundation of paper treasuries that are issued by a bankrupt entity. The absolute need for a financial reset is in place, and there would be no BRICS if that was not the case. Mm-hmm. So the world is, more than half the world now has begun the process of moving away from dollars, moving away from U.S. treasuries as the foundation for the world's financial system. There's your reset right there. The world is resetting away from the United States. So I think we were what, 2100, between 2000 and 2200, something like that. May have been even lower. I would have to go back and look at a chart. But from that day forward, the chart of gold is the same chart as a bulldozer in first gear. It just relentlessly has gone higher and higher. And the reason being, as you said, other nations, obviously not just Russia, but the rest of the world looked at it and said, hey, if they can do it to Russia, they certainly can do it to us. And that was the world protecting itself, moving reserves out of treasuries and into gold. If you look at the gold that the U.S. Says that we have and has not been audited since 1956, but let's assume that it is all there, it is all unencumbered, and it is all owned by the Treasury. That's 262 million ounces is the total in West Point, Fort Knox, etc. And that's priced on the books right now at $42 an ounce. So from a balance sheet aspect, it's nothing. Mm-hmm. Now, if you revalue it to $3,400 gold, that's a bonanza, is what they're trying to tell us. It's a bonanza. Well, no, it's only $900 billion. What about the other $36 trillion that we owe? Yeah. Now, this goes back to something I talked about as far back. I started doing the math on this, I think, in 2014, 2015. Did the math 2 or 3 years ago. And every time I come up with a number, the comments section, people go nuts. That, Holter's an idiot. He's retarded, doesn't know what he's talking about. But the number comes up to $125,000 an ounce. Right. That's what's required, just north of $125,000 an ounce in order to cover the debt. And whether they go to that extreme or not, I don't know. I'm not inside. But I can tell you, if you own gold, you are going to have an official, call it a tailwind, because governments all over the world are wanting to revalue gold higher in order to create more liquidity and ease the debt situation. But understand, for years and years, forever up until now, the U.S. Treasury / Federal Reserve never wanted the price of gold to go higher because it's a direct competitor with the U.S. dollar. And if you look, just go back, 5 or 6 years, gold was $1,300 in 2019. It's more than doubled. And the price of gold more than doubling tells you that the purchasing power of your dollar has dropped more than 50% in 6 years. Well, yeah, it is the plan, but even if it wasn't the plan in the United States, it's happening because the U.S. is no longer, the biggest economic bloc, 50% or of the world's finance / real economy. You've got nations all over the world that have grown faster than the United States. And the U.S. doesn't manufacture anything anymore. The only thing that we are still number one in, if you want, would be financial paper, stuff that you can print. Paper. Doesn't cost anything.
Paper, yeah.
Recent market developments have brought renewed attention to the potential transformation of global monetary systems. Bill Holter warns that the eventual rollout of central bank digital currencies, CBDCs, modeled after China's social credit system, could fundamentally alter the financial landscape. According to Holter, while gold revaluation remains on the horizon, a sharp increase in gold prices would likely cause significant disruption across commodity markets. Should the derivatives market collapse first, there could be a return to trading based on assets with intrinsic value, such as gold. This perspective aligns with the Austrian School of Economics, which has long championed hard money policies and views gold as a critical mechanism for maintaining fiscal discipline and curbing government overspending. On the demand side, Holter points out a divergence between retail and institutional interest in precious metals. Retail demand for gold and silver in North America remains subdued, but institutional buying is strong enough to steadily deplete inventories at major exchanges like COMEX and the LBMA. He cautions that any failure to deliver physical metals could severely damage confidence in the fiat currency system. Supporting this concern, LBMA silver inventories have dropped by 128 million ounces since November, while borrowing costs for silver rose to 7% in January, signaling a tightening market in London, likely fueled by increased industrial demand or changing investor preferences.
I can envision what they're talking about right now. Ultimately, what they want to do is they want to go to a central bank digital currency. Mm-hmm. That's the ultimate, because they want control over everyone, everything. And I think what they've done in China with the social credit system, that's ideal for a social credit system, because if you post something, you say something, you buy something that they don't like or don't want you to say or have or whatever, you get shut off. They'll just shut your account off and you're done, unless you have other assets that are outside of the system. So the first reset, I think we're looking at it right now, is trying to hoodwink the public into, stable coin's going to work, and push a CBDC. I think there will be some pushback, a lot of pushback to the CBDC. And I think the reality that nothing changed from the dollar system to the stablecoin system, I think that reality is going to be seen like immediately. So that reset may only last as short as 2 weeks, 2 months, what have you. So I think that'll be a short-term reset. I think then you'll see a revaluation of gold, mm-hmm. and that will go along the lines of Mother Nature, but they can't let a full reset go or happen, a Mother Nature reset where everything gets reset. Because what happens if you've got, 50, let's say they reset gold to $50,000. What does that do to copper? Mm. What does that do to silver for, the industrial, medicinal, solar, green energy? What does it do to those? What does it do to the price of rice? What does it do to the price of other assets? Mm-hmm. And there's going to be massive dislocations. And understand, we may not even get to any of this, because if the derivatives market, or I should say when the derivatives market blows up, mm-hmm. I mean, they are going to blow up. But if they blow up during this process, then Mother Nature takes over, and all of man's resets are done.
Null and void.
Right. Yeah, and then it becomes the system is completely burned down, and it's got to reboot and start to re-energize. But at that point in time, it does not re-energize clearing trades with dollars. Right. Trades will be cleared by something that has real value behind it. And obviously, the easiest thing is gold. And the other thing is, think about it this way: when people ask, at what point in time should I sell my gold or sell my silver?
What are you going to sell it for?
That's exactly it. What are you going to sell it for? Where are you going to put your money?
Right.
And mass selling or movement away from gold or silver will not happen until there's a currency that people can trust. Mm-hmm. And in today's fiat world, people are savvy enough today to understand that, a fiat world doesn't work. Yeah, it's a two-tiered market. I can tell you firsthand, North American demand is way down. There's a ton of sellers, and the reason people are selling is because they're out of money. Yeah. I mean, I'll bet you I've done 100 sales so far this year where people are cashing out. I've had, 4, 5, 6 saying I'm buying real estate with it. But 85, 90% of the people that are selling say, I got to raise cash. I'm out of cash. Now, that's the retail side of it. And there's plenty of supply. I mean, any type of product you want to buy, there's availability, and the premiums are as low as I've seen in 15 years.
Hmm.
Now, the other market, the institutional market, that has been red hot and on fire. You can see it with COMEX deliveries. You can see it with LBMA inventories. The inventories, the official inventories have collapsed. With huge demand and collapsed inventories, it's only a matter of time before there is a failure to deliver. And if there is a failure, or when there's a failure to deliver, if we are still on a fiat system, everything burns down, because a failure to deliver breaks confidence. And this entire episode is one huge con, as in confidence game. Confidence will break. But the paper in the West has been sold by financial institutions.
Yeah.
They've naked shorted gold. They've naked shorted silver. That's suppressed the price.
Mm-hmm.
And the cash price is in China.
Mm-hmm.
Now, when those derivatives get blown up, you have the problem is you have balance sheets blowing up. You know, you have big brokers, huge brokers, their balance sheets blowing up. And we get right back to where we were in 2008, where because it was a financial orgy, if your trading partner has been infected, people aren't going to trade with you because you're trading with an infected party. So confidence breaks, the chain breaks, and we will end up being a cash and carry market. When I say market, I'm not talking about just gold and silver.
No.
I think the derivatives in oil, in wheat, in grain, all the grains, the meats, all of those markets are going to end up being cash and carry markets, because no one is going to trust the counterparty risk to the other side of the trade.
The prospect of revaluing the United States gold reserves has sparked considerable debate, but it is important to clarify that such a move is not expected in the immediate future. Moreover, even if implemented, a gold revaluation would not resolve the deeper, systemic challenges that confront American public finance. Issues such as mounting national debt and ongoing fiscal imbalances require comprehensive policy reforms rather than adjustments in gold valuation. Nevertheless, the renewed focus on this topic reflects growing unease about the stability of fiat currency and the long-term outlook for the US dollar. If the idea of revaluing gold is seen as a signal that fiat money is losing its effectiveness, it raises important concerns about the future value of the dollar and the safety of personal savings. This debate highlights the uncertainties facing the current financial system and reinforces the need for individuals and institutions to carefully assess their exposure to currency risk and consider strategies for safeguarding wealth. As this conversation continues, it will likely shape both market dynamics and public perceptions of monetary policy. We encourage you to share your opinions and questions in the comment section below. If you found this video helpful, please support our channel by liking the video and enabling notifications to stay up to date with our latest content. Thank you for watching, and we look forward to seeing you in the next video.